Did you know that the Canadian government can actually take back part of your old age security pension, even after they've already sent it to you? I'm not talking about a small amount. For some retirees, this adds up to thousands of dollars every single year. And the frustrating part? Most people have no idea it's coming until they open their tax return and get a very unpleasant surprise. If you're a Canadian retiree or getting close to retirement, there is one number you absolutely must know for 2026. And in this video, I'm going to tell you exactly what that number is, why it matters, and how some smart planning could help you keep more of the money you've worked your whole life to earn. Stay with me until the end because I'll also share a strategy that a lot of retirees completely overlook, one that could save a couple thousands of dollars a year for couples. Let's get into it. Welcome back to Canadian Retirement Benefits, the channel dedicated to helping Canadian seniors protect and make the most of their retirement income. Today we're talking about something called the OAS recovery tax, or as most people know it, the OAS clawback. For the 2026 income year, the government has updated the threshold that triggers this clawback. We're going to break it all down in simple terms, no confusing tax language, no complicated math, just clear, practical information that applies directly to your life. We'll cover what the clawback is and why it exists, the exact new number you need to know for 2026, which types of income can push you over that line, including one that surprises almost everybody, a real-life example to make it all click, and some proven strategies to help you protect your benefits. So let's start at the very beginning. Here's something a lot of people don't realize. The old age security pension, the monthly payment most Canadians receive starting at age 65, is not actually guaranteed to stay in your pocket. There is a rule built into Canadian tax law that says if your income in a given year goes above a certain amount, the government will ask for some of that OAS money back. This is the OAS recovery tax. Officially, it lives in the Income Tax Act, specifically a section that was introduced back in 1989 when the federal government decided the pension should be directed more toward people who truly need it rather than going to higher income earners in full. Now, I want to be clear, this is not a punishment. It's a design feature of the system. The idea is that if you're already earning a good income in retirement, you need a little less help from the government safety net. That makes sense in principle. But in practice, it can catch a lot of people off guard, especially when income spikes for reasons that have nothing to do with actually being wealthy. We'll talk about those triggers a little later. So how does the clawback actually work? It's a 15-cent reduction for every dollar you earn above the threshold. So if you earn $5,000 more than the limit, the government reduces your OAS by about $750 for that year. The more you earn above the line, the more gets clawed back. And if your income is high enough, your OAS could be reduced to zero entirely. Now here's where it gets important. The threshold, the number where this all begins, changes every year. And the number for 2026 is one you need to know. Let's talk about that right now. For the 2026 income year, meaning the income you'll report on your tax return in the spring of 2027, the threshold where the OAS clawback begins is $95,323. Say that number to yourself. $95,323. That is the line. If your net income for 2026 stays below that number, you keep every cent of your OAS. If it goes above it, the clawback kicks in. Now, I know what some of you might be thinking. You might be thinking, well, I don't earn anywhere near $95,000, so this doesn't apply to me. And for many of you, that's absolutely true. But here's the thing, and this is where people get caught by surprise. It's not just about your salary or your pension check. It's about your total net income from all sources. And some of those sources can add up faster than you'd expect. Here's a quick example. Imagine you're a retired teacher here in Ontario. You receive a pension of about $58,000. You also get CPP, which adds another $12,000, and then you take some money out of your RRSP, maybe $25,000, to help with a home renovation. All of a sudden, your income for the year is $95,000. You are right at the edge of the threshold. One more modest withdrawal, and the clawback begins. Does that scenario sound familiar? Have you ever had a year where you needed to pull more money out of your registered accounts than usual? If you have, there's a real chance the clawback affected your OAS, possibly without you even realizing it. Before I go further, if you find this kind of information helpful, I'd love for you to subscribe to Canadian Retirement Benefits. We put out new videos regularly on topics exactly like this one, designed specifically for Canadian retirees. Just click that subscribe button below. It's completely free and it helps us keep making content for you. This is probably the most important section of today's video, so I want you to pay close attention. When the CRA, that's the Canada Revenue Agency, calculates whether you owe the clawback, they look at something called your net income, which appears on a specific line of your tax return. This number includes almost everything. It includes your CPP or QPP payments. It includes any workplace pension you receive. It includes money you withdraw from your RRSP or your RRIF. It includes employment income if you're still working part-time. It includes rental income, interest from your savings accounts, and any income from foreign sources. It also includes the OAS payment itself. Yes, the very payment that might get clawed back is also part of the income calculation used to decide whether to claw it back. I know it sounds circular, but that's the rule. Now, here's the one that surprises almost everybody, and I promised earlier I'd share it. It's about dividends from Canadian companies. Let's say you hold shares in a Canadian bank or a utility company, and over the year you receive $10,000 in dividends. You might assume that $10,000 is what counts toward your income for clawback purposes, but that's not how it works. The CRA applies what's called a gross up to those dividends. For eligible dividends, they multiply the amount by 1.38, meaning that $10,000 actually counts as $13,800 on your net income line. You do eventually get a tax credit to help offset this, but the credit comes later, after your clawback has already been calculated, so those dividends hit your income harder than their cash value suggests. This is sometimes called the dividend trap, and it catches a lot of retirees who hold dividend-paying stocks in non-registered accounts. Now let's talk about what does not count, because there's actually good news here too. Withdrawals from your tax-free savings account, your TFSA, do not count as income at all. They are completely invisible to the clawback calculation. Money from life insurance, inheritances, or a reverse mortgage also does not trigger the clawback. These are what you might call clawback neutral sources. Here's something I really want to walk you through carefully because it's the source of a lot of financial stress for retirees. I call it the timing trap. The way the system works, there's a delay between when you earn high income and when the clawback actually reduces your monthly OAS checks. Here's how the timeline plays out. Let's say in 2026, you have a higher than normal income year. Maybe you sold a property, took a large RRIF withdrawal, or had some other one-time event. Throughout that entire year, Service Canada keeps sending you your full OAS check every month because they're still working off your previous year's tax return. Then, in the spring of 2027, you file your tax return. The CRA looks at your 2026 income, calculates the clawback, and here's the painful part. They bill you for the full amount of OAS you received above what you were entitled to. That entire repayment comes due on your tax return as a lump sum, but it doesn't stop there. Starting in July 20 or 27, Service Canada also begins withholding the recovery tax from your monthly checks going forward to prevent an overpayment next time around. So in that same year, you're paying back last year's overpayment and watching your monthly income drop. That double hit is a real shock if you're not prepared for it. The good news is there's a way to get ahead of this. If you know in advance that your 2026 income is going to be high, you can file a special form. It's called the T1213 OAS, which asks the CRA to reduce your withholding right away. This can smooth out your cash flow and prevent that unpleasant lump sum bill. It's a simple form, and it can make a real difference. Let me tell you about a couple. I'll call them Margaret and Frank. They're both in their early 70s, retired, and living comfortably in British Columbia. Frank has a modest RRIF that he's been drawing from since he turned 72. Margaret has a teacher's pension. Together, they're managing well. Then one summer, they decide to sell their cottage up north. It's been in the family for decades, and they've made a nice gain on it because of how capital gains are taxed in Canada, where only half the gain counts as income. Their net income that year jumps significantly. Frank's income alone crosses the clawback threshold. They don't realize this until the following spring when their accountant prepares their returns. Frank owes a repayment on his OAS, and starting in July, his monthly payment drops. Margaret is fine because her income stayed below the line, but if they had known about pension income splitting, they could have moved some of Frank's RRIF income to Margaret's return, kept both of them under the threshold, and avoided the clawback entirely. That's what good planning looks like. And that brings us to our strategies section. There are 4 practical strategies I want to share with you today. These are legal, straightforward approaches that many Canadian retirees use to protect their OAS benefits. Strategy 1 is pension income splitting. If you're married or in a common law relationship and one of you has significantly higher income than the other, you may be able to shift up to half of your eligible pension income, including RRIF payments, to your spouse's tax return. This directly reduces the higher earner's net income on line $23,600 and can bring them below the clawback threshold. You elect to do this each year using a form called the T1032. It's one of the most powerful and underused tools available to Canadian retired couples. Strategy 2 is the TFSA meltdown approach. If you're between 65 and 71 and still have money in an RRSP, this window of time is actually a planning opportunity. You can strategically withdraw from your RRSP gradually each year, paying the tax now at a lower rate, and then move those funds into your TFSA. Once money is in the TFSA, any future growth and any future withdrawals are completely invisible to the clawback. You're essentially moving money out of the clawback zone permanently. Strategy 3 is thinking carefully about your investment accounts. Remember the dividend trap we talked about? If you hold dividend-paying investments in a non-registered account, those dividends count for more than their cash value against the threshold. One solution some retirees explore with their financial advisors is holding dividend investments inside a TFSA instead, where the income is completely sheltered. Interest-bearing investments can also have a similar effect, so working with an advisor to review where different types of investments are held can make a real difference. Strategy 4 is timing large one-time income events. If you're planning to sell an investment property, a rental, or withdraw a large RRSP amount, be thoughtful about the timing. If possible, spread the realization of income across multiple tax years instead of taking a big hit all at once. One large income year can trigger a clawback that actually affects your monthly checks for 2 full years afterward. Spreading that income out, if it's feasible, reduces the impact significantly. And one more important point, if your income is high enough that OAS is going to be completely clawed back anyway, you may want to consider deferring your OAS application entirely. Every year you delay beyond age 65 up to age 70, your eventual monthly payment increases by 0.6%. Over 5 years, that's a permanent 36% increase in your monthly benefit. If you were going to lose it all to the clawback anyway, you're essentially banking that higher payment for when your income is lower. Let's bring it all together. The OAS clawback, officially called the OAS recovery tax, reduces your monthly pension benefit if your net income in a given year exceeds the government's threshold. For 2026, that number is $95,323. The income that counts includes CPP, workplace pensions, RRIF withdrawals, employment earnings, rental income, dividends, including their gross-up amount, and yes, even the OAS itself. What does not count includes TFSA withdrawals, inheritances, and reverse mortgage proceeds. The timing of the clawback can create a double financial hit in the year after a high-income event, but you can get ahead of this by filing the T1213 OAS form with the CRA. And finally, the 4 main strategies to protect your benefits are pension income splitting with a spouse, gradually moving RRSP funds into your TFSA, thinking carefully about where you hold dividend investments, and timing large income events with care. The recovery tax is not something you can ignore, but it is something you can plan around. The retirees who get caught off guard are usually the ones who didn't know the rules. Now you do. If this video was helpful to you, I'd like to invite you to subscribe to Canadian Retirement Benefits. We cover topics just like this one: OAS, CPP, GIS, TFSA strategies, RRIF planning, and everything else that matters to Canadian retirees in plain language with no confusing jargon. You've spent decades building your retirement. A little planning can go a long way toward protecting what you've earned. We'll be here to help you do exactly that. Until next time, take good care of yourself and your loved ones.